This is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 30th of 2025. We got a lot of important ground to cover this week, a lot of data, a lot of rhetoric, a lot of news flow, which is influencing things. We're going to start off with earnings. This is the next 12 months of earnings for both the S&P 500 and the Russell 2000. Russell 2000 is in the pink. We can see here, very interestingly enough, going back to roughly towards the end of 2022, 2023, that essentially we've had a flatlining of earnings growth. And so consequently, we haven't had that much multiple expansion for small caps, and there's been a growing disparity between the valuations of small and large caps. In the black line here, we see the S&P 500, which, as we very well know, is dominated by very large technology firms. And so estimates, which have been paired, and I think that's a good thing, continue to grow, though. And so interestingly enough, we see this massive divergence. And usually this relationship is very tight. And of course, we have the pandemic here. But this relationship really began to break down around here. And since then, again, flatlining from small caps. And again, there are a lot of companies in the Russell 2000 that don't generate earnings, period. But those who do are not growing earnings like they are growing in the S&P 500. Here we have another way of looking at valuation. We've got the S&P 500 price to earnings ratio, looking at it from basically March, the end of March of 22 to basically just last week. And so this is a 2-year window on valuation. 22 was a bad year. Obviously, stocks were down, bonds were down, inflation was high. There was a lot of feelings of recession. So valuations did come in quite a bit. Kind of the interim trough here was about 16 times earnings. Well, at that time, we felt like stocks were greatly oversold and were primed for a breakout. And guess what? That was exactly the case. You could see that here in the ensuing months and quarters that valuations really took off, going from about 16 times to about 25 times, which is our peak. So this latest correction now has taken off from peak to trough here, or interim trough, and taken about 5 multiple points off of valuation, which I think is a really good thing, and it picked back up a little again. So basically we've gone from a price to earnings multiple of 25 to a PE multiple of about 21.3. And I think this reset is very, very positive from a valuation standpoint, because I do think things were getting a bit frothy. So we look at the drop in the stocks over the last several months. Again, going back to the beginning of the year, the good thing here is that, as I said, earnings are still growing, and this is something that I think we're going to be watching a lot. Even though earnings estimates have come in quite a bit, earnings are still expected to grow. The good thing here is that most of the reset has come from multiple contraction, which, if you're going to have stocks go down, I'd rather them go down because of multiple contraction rather than a lack of earnings growth. And so that has certainly been the case year to date. Here we have an overlay, interesting overlay that I'm not sure that I've seen this overlay before between these two particular data points. So we've got in the amber color, we've got year-over-year change in gold prices, and that's overlaid in the white with the NFIB Uncertainty Index. And so what is the NFIB? It's a National Federation of Independent Business. It really represents the small business community. And so when uncertainty at the small business level is high, which it obviously is right now, it would seem to reason that you're going to go to an asset. You as an investor are going to shift resources to those types of assets that hold their value in uncertain times, and that would certainly be gold. And so it doesn't surprise me that we have this reasonably strong relationship, not as strong back here, but certainly it has been over the last handful of years, that when you get uncertain times, people move to gold. Here we have the 3-month SOFR basically futures contract volume, and that sounds like a lot. Basically, I'll condense it by saying this. These are institutional investors that are making a bet that interest rates are going to come down this year. And right now, the consensus is their short-term interest rates or overnight interest rates are going to come down by 50 basis points, or perhaps 25 or quarter basis or 25 basis point or quarter point cuts in rates. And so you can see here that there's been a very strong spike in contracts here over the last really over the last month or so. So these are institutional investors making a bet that short-term interest rates, and SOFR has replaced LIBOR as basically overnight or very ultra short term interest rates between banks. This happens to be the 3-month SOFR, and again, these are futures contracts, not aggregate levels. So we'll shift to sentiment briefly. We've got the institutional investor exposure index here. So this represents a national institutional managers survey, and you can see that they've become a little bit more conservative, a little bit more cautious, if you will, because they're downshifting their exposure in the equity markets. Here we'll shift on this side. On the right side, we've got individual investors through the AAII. Anything below 0 represents really negative confidence, if you will, and a shift to much more defensive posture. And that's exactly what's happened over the last month or so, as these tariffs have been rolled out, I guess. And a lot of the rhetoric coming out of Washington has been very uncertain, very anxious, and the narrative's just not very positive. And so individual investors, as have institutional investors, become a little bit more cautious. And from an individual's perspective, you can see that manifested here in this chart up here. We've got retail net purchases of equities and single stocks, which peaked and now have come down. Now, again, these are a lot of investors that were buying NVIDIA, they're buying Apple and some of the Mag 7 stocks. You can see a very pronounced reversal here. And then in all exchange traded funds, you've seen really something very, very similar on the part of retail investors, that they're showing their caution. This is just this is a bull bear spread, which kind of shows you where they're hedging and where they're buying options. Again, very cautious signal there. Same goes up here, even though we're coming off of these peaks. Now we've got change in leadership. I'm going to focus really on this side first. So these were stocks or stock sectors that underperformed last year that are actually doing quite well this year. And you can see that represents, I'd say almost a lion's share of all of the GIC sectors in the S&P 500 index. And so you look at these areas: healthcare, energy, materials, real estate, consumer staples. These are things that people have to have. Just think like Kleenex. And then we got industrials, and there's a very strong, kind of a infrastructure play that's out there over the next 5 to 10 years. And so we're finally catching a bid here in this sector. And then even utilities are outperforming this year relative to a year ago. And then financials have been strong both years, again, owing to the thought that you're going to have less regulation over financials, which could lead to higher profits. And then these are the ones, interestingly enough, and I'll kind of like show, both of these are kind of in the same bucket to some extent. There's certainly overlap, but technology is a laggard this year, and it was a leader last year. And so that will help explain what's going on over here, is that for a couple of years here, we had a very low percentage of overall S&P 500 companies that actually outperformed the S&P 500, a very low number. And that's because technology, these Mag 7 stocks, were going through the roof. And so it was driving these numbers lower. Well, that's actually reversed. And so, what didn't work out as well last year is actually working out very well this year. Here we have an overlay of the Philadelphia Stock Exchange Semiconductor Index. That's in the green line here, and you can see how it oscillates. So looking at basically changes in the business cycle for semiconductors going back to 2012. So where we are now is basically we see this index moving lower, and this is moving lower in real time. And so the overlay on this is this blue line, and this is the world semiconductor sales. And importantly, it's lagged by 6 months. And so, this is basically an index which may reflect sentiment, expectations, so on and so forth. So that's clearly moving lower. And that is usually followed up by the tight relationship of this data series, even with that 6 month lag, that basically once the indicators turn south, that you basically within 6 months, you're going to have a rolling over of actual global semiconductor sales. And so that's what this chart is kind of implying to us. And so we'll have to see if it plays out. But again, a lot of this has to do with fears of tariffs and things like that. So again, we'll just have to wait and see. Here we have a chart that from Apollo, actually, that kind of gives us some sense of what to maybe look for, whether we have a recession or not. Again, we'll see this later, the Atlanta GDP Now survey, which, as I've mentioned many times, has been very good, relatively good at predicting the pace of economic growth on a quarterly basis, is predicting a negative quarter of growth here for the first quarter, which if you add the second quarter, a second quarter of negative growth would kind of loosely define a recession. Again, that's not the consensus right now. It's not necessarily my feeling right now, but again, the situation is pretty fluid. But if you start here and then you have a 10% correction, where does the market go usually? If you don't have a recession, it stays sluggish for a while, but then you have a pretty strong rally. And this, goes out 2 years basically. So you wind up having a strong rally if you don't have a recession. If you do, you can kind of languish, and then you're basically down a little bit at that point until you come out of that recession. And so it does have a bearing where the data takes us in the coming months. Here we have a correlation between the IEF, which is the 7 to 10-year Treasury exchange traded fund, and the SPY, which is, of course, the S&P 500. And what you really want to see here is what we've got right now, and that's negative correlation. That just means when stocks go up, bonds typically go down, and vice versa. And since stocks generally go up over time, that this is meant to be, a diversifier. And so this right now, it happens to be working somewhat reasonably, but there have been a large, many moments here over the last couple of years where that has absolutely not been the case. And in fact, you've actually seen more volatility out of fixed income than you have on the equity market. Here we have Treasury debt outstanding. You can see that, really the aftermath of the global financial crisis here was kind of the catalyst point to really almost go geometric here with, Treasury debt outstanding. Of course, we had TARP, we had a lot of these other programs, and then we hit the pandemic, and that, if anything, that only accelerated. And so, this is something we've got to watch because we're getting close to $30 trillion, actually $28.6 trillion. And you go back to the global financial crisis, and that was 5. And neither party seems to be motivated to kind of really truly tackle this outside of just sound bites and Doge and stuff like that. Whether you're left or whether you're right, I mean, neither side is really focusing on this as an issue. And this will come up again later, but I want to draw your attention to this chart that we basically have, the $29 trillion in the treasury market, that 30% of it is owned by foreigners, or about $8.5 trillion. You've got institutions, government, federal agencies, and then households down here, which actually don't move the needle nearly as much as you think they would. But foreigners do. And so, we want to make sure that foreign investors are happy. With their investment, of course, we can't make sure they're happy, but we hope that they're happy and that they don't repatriate those dollars back to their home markets because if that were to happen and you get like a big reversal in the dollar or some other kind of political action, then this does present a risk to pricing. Okay, on the left-hand side, we've got some data from FS Investments. In the amber line here, we have really the number of mentions of the word tariff in conference calls, and this is also data compiled by Bloomberg Intelligence. You can see that basically around the time of the implementation of the Trump 1.0 tariffs, that went up for a while, and then it went down, remained fairly benign, but has really spiked lately. Again, not a surprise, just kind of confirming what we all thought. And then also down here in the black is very interesting because of the tariffs. You're seeing kind of a rapid rise in the number of mentions related to reshoring or bringing manufacturing back on shore. And that's been a lot steadier than has been the mention of tariff in general. Again, owing to the fact that you've got supply chain shifts and reshoring, and those things don't happen overnight. They require a lot more diligent and multi-year planning, in fact. And so it doesn't surprise me that this line is relatively, it has a fairly manageable slope here. And then on the right-hand side, we've got average tariff rates on imports, and you can see that they were relatively benign. Even February of this year, 3.9, which again represents a reasonable increase over what we've seen over over varying points in time. But what the problem is leading to basically almost not quite a doubling here, but then you've got 10.8 over here. And so again, April 2025, if you have effective 10.8% tariff on all imports, that should have some type of impact on economic growth. Here we have the Federal Open Market Committee dot plot. So this is your trusty voting Fed members that set interest rate policy. This is their estimate of what's going to happen, and especially if you look over these out years, there's a pretty wide disparity. Usually you find like dots on maybe 3 or 4 of these lines, but never do you get like 6 lines worth of speculation. And so the first takeaway here is that their dot plot for 2025, if you will, looking about 3.8, 3.9 issue, if you will. And again, not everybody's in line with that thinking, but this is kind of where the average is. That doesn't represent a huge drop. And so to me, that says that the Fed doesn't expect a recession this year. It does expect slowing over time, which will help the Fed. Basically, it will prompt and or give them a green light to reduce interest rates, and that is indeed the expectation moving forward. Here we have some worries over unemployment. You'll see a chart on this later that speaks to inflation, but clearly you can see that the risks of unemployment are weighted to the upside. You've got a number here that is almost as high as it was in 2022 when we were really worried about a recession. The markets were going haywire. You really don't see too many FOMC members that feel like maybe unemployment is stable, and that the risks are definitely weighted to the upside here as we look at over the coming months. Here we have border encounters, which is really interesting. An encounter is defined as basically undocumented workers arriving at the border and not being eligible, or it pertains also to what we would typically known as like illegal immigrants that that are basically interdicted and caught and removed and sent back over. And so you can see that these border encounters have really gone down. Not quite zero yet, but they're pretty low, and that tells me because you've got a high distribution of immigrant labor for, like, say, the ag industry, which we're going to look at in just a second, since you have that, you depend on these migrant workers, but you're seeing that fewer and fewer of them are actually getting through. Here we have crop farm workers, to my point in the prior slide. Where are they coming from? Basically suffice it to say that you've got 42% that are undocumented, unauthorized workers in the crop industry. And so, that could have like the law of unintended consequences, that you wind up having, higher, costs at the supermarket for some things, just because, people are having to hire regionally. They're having to basically hire US born help to fill this void. Otherwise, they're going to be putting out a lot less output. So here's basically a chart of the number of FOMC members that are worried about higher inflation. So, basically just as we saw with employment, we've got similar trends here, that you've got basically stronger weights to the upside on inflation. And again, not necessarily a good thing, but these are just expectations. But it does filter into. It is very interesting because their dot plot suggests that interest rates are going to continue to move down over time. This tells me that they're going to be laser focused on inflation risk over the next couple of years. So I think a case to be made that interest rates like net aren't really probably going to do that much. So we showed you this version of this slide when we were talking about treasury bonds. Now let's show you the stock side. So green line represents foreign holdings of U.S. Corporate stocks. You can see that line actually continues to meander higher. So you have a strong interest in corporate stocks, whereas our domestic investors have much more limited appetite for overseas assets. But again, this presents a bit of a risk, just as the concentration in treasuries does in that chart that we have already seen. Here we have a distribution of what those foreign investors own. And you can see if you go back to 2010, which is about 15 years ago, about a third of the portfolio represented equities. And then you had, a rather meaningful or measurable distribution of assets across the other kind of the subclasses, if you will. And this is a pretty well diversified portfolio. You had treasury debt at 22%. That's now actually gone to 15, whereas equities have gone from 33 to 60. So everyone wants to be on that bandwagon. They want to catch the next wave. And so they're inherently becoming more risky with portfolios. And I'm not going to opine on what the implications of that are. Just suffice it to say that you have had a real strong buyer of U.S. equities. And, I think that brings with it some risk, particularly with what's going on in the geopolitical sphere. Here we have some data from BCA Research. I think there's a lot of validity to this. This is from Marco Papek, one of their senior strategists there, the political strategists. So, what we're showing here is that basically that America has been funding growth across the world because we are net consumers and we have a very strong consumption platform. And so this is viewed as having, some exceptionalism, if you will, but just basically being recognized for all the benefits that there are, and buying. In U.S. buying, foreign goods, they're obviously cheaper when you have a strong dollar, and in many cases, maybe they're better made. But that's not necessarily shared by the rest of the globe, and you can see that this distance is only getting wider as we get across time, and so it's actually pretty odd that we see this. So U.S. consumption is really helping to bolster the rest of the world. And I think that's basically, in a nutshell, what this chart is trying to tell us. Here we have wholesale inventories. They've been positive for the last couple of quarters. In fact, inventories were on a monthly change basis. They were up 0.3%, seasonally adjusted. Month over month, they were up 1/10 there, and you can see the trend is can be a little cyclical. We had a little bit of a multi-month run of positive data before it turned a little bit more lackluster. Honestly, I'd expect that number next month to probably move higher when we get really March data that will begin to reconcile what people are doing in advance of the new tariffs. Here we have a chart on domestic income quarter over quarter. I haven't shown you the domestic income number. It should be roughly similar to GDP because you figure that income translates into growth and is a prime determinant of growth. But see here that income had a relatively good spike over the last month. We're looking at about 4.5%, and obviously that will be ahead likely of overall economic growth. All right, and here's the long-awaited GDP Now estimate. You can see down here we're looking for negative growth, and that was a real sea change when we went from February to the beginning of this month, because for a long time they were expecting 2-3%, and then tariffs came about, and feeling as if that's now been reversed. Here we have gold adjusted, which is an interesting kind of offshoot to this. And we have seen a lot of strong gold shipments and strong demand for gold, not just as a financial asset, but as for a lot of different things. In fact, you can see gold shipments to the U.S. have really spiked over the last several months. This chart, we've got U.S. durable goods were clearly better than expected by about 0.5 percentage point there, and then you've got orders on a month-over-month basis. We're up about 4%, and it's good to see that, and it is healthy, so we'll continue to watch that. Here we got durable goods shipments month over month, again positive, following several months of reasonably positive performance there. And then I'll pivot over here, and this is shipments of non-defense aircraft and parts. And so where this is computer and electronics, this is everything, including computer and electronic products, that is not defense or aircraft or parts. And that was particularly strong. That was up 0.7%. Very strong indicator there. And this one down here is U.S. capital goods orders, non-defense, ex-aircraft, and you can see that that was slightly below estimates. This slide is the U.S. 2-year Treasury break-even rate. So this is basically an estimate of inflation. As is known, the latest estimate of inflation as determined by the 2-year break-even rate is about 3.3%. You can see that here, that basically we've continued to move higher, which is interesting because the market's also expecting 2 rate cuts this year. And if you see, if your implied 2-year break-even rate is moving higher as well, that seems to conflict with that. So it's just one of the many things that you just have to sort through on an ongoing basis. So I think this chart shows you how people are front-running the expected tariffs that are hitting on April 2nd and those which may be announced beyond that. So you can see goods trade balance has decidedly fallen out of bed here. This is in billions of dollars, so this is an aggregate number. And you can see, like, basically back as early as 2023, that was, negative 85-ish, and now it's basically almost double that. You can see that manifested here. These are good imports, products from abroad, again, trying to front run the tariffs, whereas exports are just basically flat over roughly that same period of time. You can see U.S. imports of consumer goods spiking here due to high demand. We're looking at corporate profits now. So oddly enough, with all of the hesitancy that we see from a capital budgeting standpoint, the companies are still, incredibly profitable. And you look at this profit margin here on an operating basis. I mean, you're almost at 13.5%. Again, we just haven't seen that in a while. And so, companies are more efficient. They're making use of productivity. They're limiting costs. And because these margins are still high, that tells me that they have to be pushing some of this onto the consumer. Because if they were to absorb that, you would see these margins contract, not continue to expand. See, pending home sales had a pretty bad month. We've been kind of, maybe slightly favorable to housing over the short run. We do see some conflicting data. We see inventory on the rise, and here we've got sales index for pending home sales really dropping quite a bit. Now we've got a couple slides on regional Fed surveys. This is the Kansas City Fed. You can see their manufacturing index is still negative. It did kind of tail up a little bit, so it's less negative, which is, from a trend line basis is always what you want to see, even if the aggregate data is not conducive. You've got new orders. That one, however, is moving down. So while you've got, current production that's moving higher, you've got new orders which are moving down, and then you've got prices paid here on manufacturing also moving higher. Got another busy chart here, or set of charts. We've got the Philly Fed now, and it's non-manufacturing index. So we were looking at manufacturing before. Now we'll look at the service sector, and you can see how that's falling out of bed. The non-manufacturing outlook has turned quite considerably and quite viscerally, in fact. And then you've got here new orders, which are down, prices paid, which are up. Not the best of circumstances right now. Here we have the Richmond Fed. So they have their own manufacturing index, and all these, regional Fed offices have their surveys to some sort. And so this one just happens to represent, kind of the Virginia area, Richmond. This is our manufacturing index, which had been positive, but just turned negative. We've got the service sector index, which is also negative. That part happens to be fairly consistent with what, basically what we've seen in other Fed jurisdictions. I thought this slide was pretty interesting. It gives us some insight based on age. You got 20s here going to your 60s of what percentage of plan participants, people that are eligible participants in 401k plans, have outstanding loans. And I view this as a bit of a kind of an indictment on the health of consumers right now, because if you're borrowing from your 401k, that would typically indicate that there's some stress in your life that you're trying to finance through your savings. And we see here that when you get to your 40s, that we've got basically 20% of all plan participants have some kind of loan against their 401k, which, again, you're having to pay yourself back with interest to recompensate your plan. This is, per IRS rules. But it does indicate some stress. What I can't show you here is what this kind of particular chart, this time series, would have looked like maybe 2 years ago or maybe even 5 years ago. But obviously the dependency on funding, current expenditures or current issues out of your 401k goes down over time. The hope here is that you provide better education for people in their 20s so that they make better decisions and maybe not have to have loans loans against their 401k, in their peak earnings years so that they could drive more of that to the 60s, 70s, and beyond when they're going to really, really need it. This chart is rather busy, and I thought it would be kind of a good one to end on. So is really looking at valuation through a different lens and what are the implications of the current levels that we're seeing. So this is taking the traditional 60-40 portfolio. You hear about this a lot, 60% stocks, 40% bonds, kind of long-standingly held as the typical growth portfolio, if you will. And so what this study did is it took the earnings yield. So this is earnings over price. This isn't PE, which we saw had come down quite a bit. This is earnings over price. And this is actually as of February, so it doesn't really capture the volatility that we saw in March. And so basically it takes the earnings yield, earnings over price, and then assigns it a 60% weight. And then it takes the coupon yield from fixed income and assigns it a 40% weight. And so what you get is a blended average, a weighted average, if you will, which right now, as of the end of February, was about 4.6%. And you can see the average, long-term average of that weighted average earnings or yield is about 6.1%. And so statistically speaking, you're going to have about 2/3 of all observations are going to be between these two lines, and right now you can see that we're very, very low. And so anything really below that average is viewed as being expensive. You just think about like yield, like if yields are high, prices are low, prices are high, then yields are low. So it's basically, it works in inverse there. And so we have, right now we're about, as I said, about 4.6. This lower boundary here is about 4.5. So, we are relatively expensive by this yardstick. But again, valuations went down during the month of March. So I'm sure this improved somewhat. But anyway, just to illustrate the point, moving over here, we take that, basically that 4.6 earnings yield, which is about right here, and that puts us right in this spot. And so, plotting the earnings yield here, if you will, against 10-year expected annualized return, looking into the future, that brings us to about 5.4%, which is not terribly great. A long-term average, I would think, is going to be somewhere in the 7 to 8% range. This is a line of best fit here, so you got some outliers here and here, but if we did have a valuation reset, then our numbers are going to look a lot closer to normal, which would imply, again, that 7 to 8%. But when your valuations are really stretched, your future expected return is necessarily going to be a lot lower. That's all we have this week. A lot of important data. I hope you've enjoyed it. Have a great week. We'll talk to you again soon. Take care. Bye.